Welcome to a new season of Market Makers IL, where we pivot slightly and do a deep dive into the world of private banking. We're going to tell you why, we're going to tell you how, we're going to tell you the details of some of the products. We think you're going to learn a lot, we're going to have a lot of fun, and we hope you do too.
And still, no suits, no ties, and we'll leave no question unasked.
And we'll be talking about conversations that talk about shekels.
And some dollars.
And no investment advice. All right, Michael, great to see you back in the studio. It's actually the first one we're recording in 2026, and wow, then I feel like we've lived a year already, given the geopolitical and market-moving events, everything from the Middle East and Iran all the way through talking about capping credit card fees in the United States. So it's been there. But here we are, and we're back to, we in our first two episodes, we did a little bit more of a pivot, and we were talking about the EFG Global Outlook, and then we were talking a little bit about how people work with EFG Wealth Management Israel. And I think today we're going to pull back the covers even a little bit more, and we're going to do we used to call these in Technology Research 101s. We're going to do that introductory course to how would an Israeli knock on our door, 20th floor, 3 Rothschild, and say, I want to work with EFG Wealth Management Israel. So let's talk about it. And basically, you want to open an account with us, what do you have to do? So let's talk about some requirements, some topics, all the things that we get asked as people come in the door and we start a relationship with some of our prospects and clients. So first of all, let's talk about, can anybody just knock on the door and come on in? What do you have to do to work with EFG Wealth Management Israel?
Well, first of all, anybody can knock on the door, and we would be happy to have a coffee with them and then understand, what's going on.
We are nice guys.
Always welcome. We have a nice view and good coffee. But in all seriousness, so people who come and knock on our door are investors who are looking to open, I would say, a bank account in Switzerland, but getting from us in Israel wealth management services, advisory services for which we do have a license in Israel. We have actually a license of investment marketing. And we
are all licensed, which is interesting because what does that mean for us? One of my good friends said to me, there are all these IPOs coming in Israel. Are you buying any of the stocks? And I said, sorry, we can't do that.
We can't do that, exactly. So as license holders, we have all sorts of restrictions, which is also, in my view, a very good thing to be licensed, meaning that you have a regulator looking at what you're doing and you can do whatever you want. So that's also good discipline for us. So investors who come and see us, basically, there's a few, obviously, requirements, and for it to make sense, first of all, you need to look at the need of the account, what the client needs, and if you need to deposit like maybe $100,000, maybe we're not the right place. What we're doing is wealth management, so it's usually kind of like the millionaires' wealth management services. So we're usually talking about a few $1 million that you have to invest in the medium to long term. So here, we have substance to talk about. And then basically, we need to figure out a few things like risk profile, what do you want to do? And obviously, we need to figure out whether you are a qualified client, an eligible client, according to the local regulation, also a professional client or not, according to the Swiss regulation. So all kinds of restrictions or all kinds of like definitions which will allow us to be able to determine whether we'll be able to offer, to show you all kinds of products or whether we'll be restricted. So for example, clients who don't meet, I would say, eligibility criteria for one of those categories would not necessarily have the right amount of wealth, of liquid assets, or not necessarily the right amount of knowledge and experience. So we have to take into account all kinds of things together with the risk profile of the client. We fill in like a full questionnaire in line with the regulators, obviously, definition, and then based on that, we come up with the right categorization of the account so that we can provide the right service. So size, knowledge, and experience are things that I would say would determine what we can and cannot do with you.
And I think it's important to note here that this is not something that we have any control over. It's also something that we want to fight too much. And so I think you come in the door and we make the determination. That's really the first bar because, and we talked about this on the last episode, the most important thing from an advisory point of view is to not provide advice to people who not give the wrong kind of advice to the clients, and also to make sure that the money at risk is profiled properly. And so, as you said, this is not your, we call it in Hebrew, the avor shov, the osh. This is not your daily liquidity
cash account. Yeah.
This is the money that you are putting away for growth or security, depending on your investment requirements. And so it's very important to meet these requirements and to not really push back too hard on them, because they're pretty inflexible for a reason. So we talk a little bit about account sizes, but then the question becomes, okay, I've got this. I'm looking to do things with you, and you've got a whole range of clients, and we see them all, from people who are very interested in the day-to-day market moves, who are trying to buy stocks, who've looked at Bitcoin, who've done all these other things, and then you have what I would say is the set it and forget it kind of crowd, where they're really not looking for much advice. They understand what they don't understand, and they're actually just looking for guidance and a trusted advisor to help them create the outcomes that they're looking for. So let's walk through some of these, just because I think it's important to label them and for people to understand what they are. So what's an advisory account?
An advisory account is an account whereby a client is going to invest his money, but using our advisory services. So you're Mr. Client, you come to me and say, hey, Michael, I've got $5 million to invest. This is my risk profile. What should I do? And then, we come up with a few more questions. We kind of like determine the right, we make a proposal with a few ideas. And then the advisory interaction means that I have a discussion with the client. And then during that discussion, I will figure out what the client likes, dislikes, feels comfortable with, doesn't feel comfortable with. Based on that, we build a proper portfolio aligned with his risk profile that would meet his requirements. So I have provided you, Mr. Client, an advice to to invest your money, which you approve, and then we place the trades based on this approval. So that's advisory. Without your approval, I cannot place any trade.
And I think what's important here is, when I think about this now, because it took me a while to, when we say advisory, we mean from the perspective of EFG Wealth Management Israel. It's the client taking advice. We're the ones providing the advisory services.
Correct.
And the client is the one accepting those services. Now, okay, you're in an advisory situation. What's the remit in terms of, okay, now you've taken the advice, you sat down, you had that initial meeting. When do I come back to you? Do you look at the market and say, oh my God, this isn't working, we better change it quickly? Does the client call up and say, oh my God, this isn't working, I got to change it quickly? What's the cadence of the advisory service?
So I would say it depends on each client. Obviously, we do regular monitoring of the account. We have tools to monitor the accounts in the background. So our investment advisors, our platforms allow us to kind of like check what's going on in the market. We have obviously our colleagues from Switzerland providing input on the different products we have recommended. So what we do in general is very, very regular, in a very structured approach, portfolio reviews with the clients. And then, some clients like to, be left alone and, not talk about their money for a long time. Some clients do like to monitor the account. And based on that, we agree on a kind of frequency of those discussions. Whether, at every market move we'll be changing and doing like turnover in the portfolio, not necessarily, unless the client is very short-term oriented. But in general, we're looking at relatively medium to long-term horizon for those investments. And therefore, obviously, if we need to take immediate action, we would do it. But in general, we try and not get too anxious about market volatility, which is also something that we determine from the beginning when we fill in those questionnaires. We try to understand what's the client's, understanding of market volatility, of uncertainty, and all these kind of things, and what's the client ability to, accept market risk. Based on this knowledge, we kind of like run those portfolios.
What's your approach to two things? One is, some of these accounts are joint accounts, and a lot of times you'll meet a husband and wife and it's actually very hard to predict which one is going to be which. You have one who's very interested in taking more aggressive positions and one who's much more conservative, can't stand to see a loss. How do you make that balance in the advisory portfolio? And then the second part of that question is a lot of our clients are seeing some of the products that we see for the first time, and you're introducing new product. How do you really get into the details of a new product? Maybe a hedge fund, it's the first time they're looking at that. Maybe it's a structured product, it's the first time they're looking at that. How do you get comfortable with the fact that the client is ready to be purchasing that kind of product?
Well, so first of all, I think it takes time for the client to be comfortable with the product. So if I introduce a new product to the client, I need to make sure he understands the product. So we go through it in details. And usually it takes a bit of time for him to digest the information, to understand the risks. So it would take a few, I would say, meetings until he would like and try this product. We would not, quote unquote, push a product to a client if the client is not 100% comfortable with it. So for us, the education part is extremely important. We have to be, patient. If I have a conviction, but the client is not convinced, so that's not a product for him, and then we move on. But in the meantime, we can continue educating the client on those kind of products, and maybe in the future, and this is what we see often, maybe in the future the client would be, comfortable to invest in it because he understands the benefit of investing in this product in his portfolio.
And I jumped to a question that wasn't really related. So let's go back to that couple that has different investment profiles, trying to build a profile for the actual account.
So in my view, there's no such thing as a joint account where the couple has a different profile, because this is part of the process from the beginning. They agree together on the risk profile of the joint account. There is one risk profile for the couple. So once we have defined that risk profile for both of them, which is an aggregate or which is an agreement between the husband and the wife on what risk profile it will be, then we run with that. But sometimes, even, despite certain risk profile, if we show certain products, if we discuss certain products, one of the spouses is not necessarily in agreement, they usually have a discussion in front of me, and I'm trying to help them navigate that, the considerations about the product, and then we get into an agreement whether we go, for or we don't go for that product, despite the fact that it can be in line with their initial risk profile. So you have to be kind of like flexible and to adjust, to adapt to the couple's, I would say, views and mindset at the time of the investment discussion.
All right, so I think we've covered what advisory means from our perspective. Another big headline kind of account is a discretionary account. Now,
Right.
that's not our bread and butter because we are an advisory office, but we do occasionally run into somebody who asks us for a discretionary account. Walk through what that exactly means and how that would happen for a client.
So, as you mentioned, we do not provide portfolio management services out of our office in Israel. We refer clients to our portfolio managers, which are, in this case, based in Switzerland. So the discretionary account means that you cannot be bothered with getting called about investment ideas. You trust the portfolio manager to manage your portfolio, your assets, based on a risk profile that has been determined from the beginning. So you said, if you're telling me or telling the portfolio manager, I have a balanced risk profile, this is $5 million, you go and manage it. So we pass it on straight to the portfolio manager in Switzerland, and they would manage it according to the, bank's investment convictions, asset allocation, strategic allocation, chief investment officer view, etc., etc. And that's all it is. So the client really is not getting involved with the investment decisions in the portfolio in a discretionary mandate. However, some large clients, some large portfolios can be, I would say, including some of the clients' requirements. So some clients have some specific requirements. It can be about the asset allocation. It can be about specific products that they do want or do not want. And therefore, the portfolio manager would be adapting, this into the portfolio allocation. That is also important. Usually, in many institutions, this is a service that is provided above a certain amount of assets.
So again, discretionary here means it's at the discretion of the fund manager that is selected by the client. Then we have clients who just want to do trades. They don't really want to be bothered. They want an account that is active or inactive, but they really want to do most of it all by themselves. It's not something that I think we spend a lot of talking about because we are an advisory firm, but it should just be pointed out that this kind of account is out there. Isn't that true?
Exactly. So it is called execution only account. Usually some clients have their own convictions. They like to trade on their own. They have their own ideas. They share ideas with their friends. They don't need advice, and therefore they just pass on an order and place their own orders. So there's no advisory here in the picture, and then just execute. So they ask the bank to execute the order on their behalf.
We talked a little bit about this. So we've got individual accounts. That's for individuals and people. Is there anything more to add on that in terms of what we would consider an individual, or how an individual or private person would come and open an account with EFG?
Yeah, some individual people manage their assets, either in a named account, so like under your name, or under, I would say, a corporate structure, which is not a company per se, where, with an operation or with staff and salaries and suppliers. So it's just like an entity that some people are using, or as we mentioned, as a named account, as the individual account. There are also corporates, like proper companies with proper operational activity. Why do they come to us for advisory? Because maybe they have excess cash that they need to manage and they need to optimize. So some successful companies are in need of advisory in order to optimize the cash in their treasury, and they don't necessarily need for the short or medium term. And we help them with that.
So again, it's a corporate advisory account or a corporate discretionary account, I suppose. Yeah. But again, we are not looking, or these kinds of customers are not using, just like with the individuals, we're not talking about daily money flow.
No, that is not corporate banking. That is still wealth management. So for their daily money flows, to pay their suppliers, to pay the salaries, to do whatever corporate actions, so that is not something that we would do in our day-to-day.
What about trusts? We hear you accumulate wealth, and people and a lot of people, for generational wealth planning, start utilizing instruments like trusts. How does that fit into the whole account opening structure?
Exactly. So we have clients who have already arranged for their own trusts and, I would say, next generation planning. They speak to their lawyers, they speak to their partners, and they come to us and say, look, we have a trust already that has been set up. We would like to open an account for the trust. That we can do. So we talked about individual account, we talked about corporate account, but we can also do trust account. And obviously that is technically a different type of account opening process, but it's still very, very similar to the other account opening. So that is something obviously we can do. We can also have, we have clients who maybe need help with setting up a trust, and that is like a different department of the bank that can help with that. It's called the Wealth Solutions Department. We have specialists who are actually very well experienced and do all kinds of things with regards to trust structure. And usually we can add value by introducing them to our clients.
All right, we've gone through the kinds of accounts, but I think our bread and butter, we are investment advisors. We are a shivuk hashkaot in the local license, which means we give people marketing advice on the markets here. A lot of what happens just happened on paper, though. You're in a room, you sign some documents, we go through a risk profile. Maybe you can address two different scenarios for us that'll bring this to life. One is you've got a couple in the room and they've got different feelings about where they want to go. How do you bridge that gap? And do you split the account? I know we said it's one account and they all work together, but there's obviously a give and take here. So that's example number one. And example number two is this is a very, very dry kind of situation. We're sitting in the room, we're talking about my risk profile, And on paper, I love risk. I don't care if the market's going to move. My portfolio is, I don't need this money tomorrow. It's for my grandkids. But then the market drops 20% in one day. And so walk us through what that investment advisory or that marketing advisory kind of license, what kind of conversations do you have to kind of solve or handle both of those scenarios?
Yeah, so I'll start with the second one. So it's very interesting. One of the questions that we ask when we fill in the risk profile is, if the market was to move down by 20%, say, for example, what would be your reaction? And then a lot of people may say, yeah, I do nothing. It's okay. The market will go back up.
I'm a long-term investor.
Invested, a long-term invested. Now, the market actually goes down by 20%, and the discussion is totally different. Client calls me. I was in situation where, what's going on? You need to sell those positions. Let's review the portfolio. What shall we do? I was like, okay, first of all, my role is to remind him of where we stand in terms of risk profile, in terms of risk reward, in terms of our objectives for the account, and then just put things in perspective first. Where do we stand, and what we want to achieve? Now, compare that to the actual market situation. What do we have right now? And then we bring an analysis, a market analysis. What's going on? Okay, is it like a short-term volatility event, or is it like a real crisis based obviously on the knowledge we have? And then really together with the client, we decide what to do. But very often there is a psychological impact. And no matter what happens, in most of the times the market will go back up based on those examples of thinking about. But in those exact situations, the clients would just like sleep better at night if we sell part of the positions. And eventually I cannot fight it. I give him my advice, what to do, how to maybe mitigate some of the risks, but not just like sell everything in that situation. But eventually we do what the client, I would say, wants to do, because that's his decision, that's his money. So in some cases, clients have been listening to our advice. In some cases, they still, sold. Obviously, later they regretted that they sold, but at least they told us that it helped them sleep better at night. So eventually, every client is different. Every client thinks different and feels different about his own money. So obviously, we kind of like adapt to that. Regarding your other questions about the couple, it's very interesting because we fill in one risk profile for one joint account for two people, two spouses. In some cases, you may see the one of the spouses who is less involved with investment. In some cases, very interestingly, there was one older couple. I would say they were in pension, and but very active with their portfolio. The husband loves to trade stocks in and out. That was he knows about stocks better than a research analyst, maybe better than you, Joseph.
Definitely better than me.
and that is very interesting that his wife was actually also very involved with the advisory process, asking a lot of questions about other things like funds, hedge funds, private markets, and he's the one who actually says, let's just do stocks. And then she said, no, let's diversify. Let's do a little bit more things because of the benefits. And it was fascinating to see that couple going through that discussion. And we were trying, obviously, to help them, obviously, understand the different risk about each scenario and the benefits of diversification. It was all in line with their risk profile, but different products. So it's interesting to be in the middle of that. Eventually, you just let them fight, and then you decide. But no, we try and help as much as we can, obviously. But we cannot interfere because that's their own decision at the end of the day. There was another couple, very interestingly. One is in charge of the investments, and the other one is in charge to keep her husband in check with regards to their lending capacity. This is a couple that likes to take some loans, and therefore, whenever loans are involved, obviously there is an element of risk. We can talk about in details in a separate conversations, but the lady was extremely structured in the way she was monitoring the risk exposure, the lending exposure of the portfolio, while the husband was just like going, all in on all kinds of investments. That was kind of like, I was fascinated by that team effort and how structured they are, how well organized they are, with those two different aspects.
Sounds like the perfect team because it actually makes your job easier because you don't have to be the one playing bad cop with the client.
Yeah, exactly. That's actually very good. But at the same time, they need a lot of input from us. So we're also very active, and it's also our role to kind of try and keep them as safe as possible. Despite the high risk level this account had.
Two great examples. There's also, and I think this is something that you hear about. People build something called a fund, where either they work with a bunch of people or they have a lot of their own clients, and then they come and they say, okay, I'd still like you to be part of my process. Is that fund structure something that EFG Wealth Management Israel can work with?
Again, as long as there is a structure that owns assets, investments, that needs to be what we call custodized into a bank, then we can assist with that. And therefore, EFG is equipped to open accounts for such structures like funds. Again, obviously, we always have to take into account all sorts of, regulations, restrictions, and all these kind of things. But if we tick all the boxes, this is technically possible.
Let's talk about onboarding. I come in, I knock on the door. What is the most important thing from a onboarding perspective? You're advising the client. They want to work with you. How long is it going to take for you to start working with them?
How long is a big question. We've managed to get accounts open in a few days, and for some others it took a few weeks, even more. It really depends on a few things. First of all, on the complexity of the account opening. It depends also on the client's ability to respond to all of the requirements. And what are the requirements? They are, first of all, you need to sign a few papers. You need to provide a few documents in the case of a more complex structure. And therefore, the ball is on the client's court, because he has to provide us with information. So if he provides us this information very quickly, then the ball is in our hand and we can treat it quickly. If the client takes time, then the process can be longer. So this is why this is a very variable answer. So we have documents, we have to sign documents, we have to send those documents to Switzerland. There is also what we call the infamous KYC process. The KYC is basically understanding the client's what we call journey of wealth. What has the client done? What's his CV, basically? What's his career about? What's his background about? And how has he made his wealth? Where is the money coming from? And this is what we need to figure out together with the client in order to make this story plausible. One, for us, and two, also, obviously, for the regulator. Because if the regulator knocks at the door, wants to understand, whether we have onboarded clients with a plausible story or not. So we have to be, I would say, pretty accurate and plausible in this story. So the clients very often, they kind of like collaborate and share with us information and the story. And it's fascinating sometimes to hear about those stories that originated from like 30, 40 years ago, and see the whole journey of wealth for this client. The success stories, the ups and downs, the surprises. I mean, that is actually a process that I enjoy a lot. It requires asking a lot of questions to the client sometimes, but clients are actually very interested sometimes in this, especially I would say the slightly older clients who, I take them back to the 60s and 70s to old memories, and it leads to interesting conversations sometimes.
I think when you think about this, it's easy to think about this as sort of an exam with a doctor that you don't want to do. How do you turn that meeting into the smile on your face that you just had when you understand how somebody was able to succeed? Perhaps they started with nothing, they started a business, they succeeded, and now opening this account in some ways is the fruit of their labors. It's a sign that they've actually put away enough to start planning for the next generation. How do you make them feel like it's not a trip to the doctor, but it's just a really important part about starting this relationship off on the right foot?
Well, first of all, I think it's important to understand that we here build a relationship between what we call the relationship manager and the client, because this is something that is supposed to be running for a long time, a banking relationship, right? You're going to have a relationship with EFG. Supposedly, we will work together for many years forward. And in order to do that, it starts somewhere. It starts with, tell me your story. Who are you? And I'll tell you mine, by the way. I also share my story, which is usually much shorter than the client's ones. But this is where the relationship starts, and this is where the trust starts. And I need to basically tell the clients that help me help you. You tell me your story. I'll make a nice picture story of your background. Then the account will be open. Then we'll be able to obviously, run your portfolio and build something for the long term. So I think it's a matter of building a relationship, building trust, and it starts really there.
And I think when I hear that, what I feel is that you come back to where we started, which is you walk in the door, you're looking for something slightly different than a day-to-day banking account. And part of that is a longer-term relationship where you are looking for really, and it's part of our license, you're looking for an advisor where you are going to be, not daily, but you're going to be in a very long, hopefully a long relationship with somebody who is the steward of some of the most important things that you have put aside for over the course of a working career. And so to me, the more open it is from both sides, the more easily you end up in the right place, both with regard to all the things that we've talked about. You end up in the right place with the kind of account, you end up with the right kind, with all the right product, and you end up with the right feeling as you get through that opening, when you become a client of ours. Look, those are most of the topics I think we should be going through as people think about opening with us. Is there anything you think we haven't covered, or a really important thing you would take away for that person that knocks on the door and says, "Hey, I'd like to work with you"?
Well, I think today there's a lot of banks, a lot of good people around there. I think what's important is to get to know each other and to build trust, because eventually, I always say, it's a people's business. So you have to trust the people you work with, and you have to feel comfortable with the people you work with. You have to feel comfortable with the level of service you're getting, the level of responsiveness you're getting from your partners. And it all starts there eventually, because the markets are moving, the portfolios are moving, but eventually the level of service is important. Therefore, you need to be feeling comfortable with the people. It starts there, really, in my view.
Great. Well, I think, listen, we are looking at some of these as primers. I think these should be able to sit on the shelf for a little while. Someone who knocks on our door, look, we can refer you to this. And I think hopefully this is a topic which we'll come back to in more detail. And we'll have a lot of questions for people who come to us and ask us specifics. But as an overview, I think walking in the door and seeing what you get, I hope we've knocked that one off the list for the things we're going to talk about this year.
Fantastic. So looking forward to a great year with many meetings.
Exactly.